rules, some ground rules. Should please ensure that our mics are muted. You can always use the chat box, especially even when our mentor asks a question. And yeah, there's already a question time. There's time for you to ask questions. So we just have to please listen to the lecture our mentor wants to give and make good use of it. Thank you. I'll call on our mentor, Miss Allen, to please take the floor.
All right, welcome everyone. I hope we had a wonderful week. This weekend is kind of a long weekend. Yesterday was a public holiday and we're having our session today. So I want to welcome each and every one of you today to today's class. I'm excited to have you guys here. Last week we didn't have a session because I was unavoidably unavailable. So I'm merging two classes today for the 4th and 5th week. For the 4th and 5th week, I'm coming. We are to have building habits for saving and smart spending, and investment basic introduction to investments and financial planning. So these are two topics we are handling today. I'm about to share my screen right now. Come in. So are you guys seeing my screen?
Yes, ma'am.
Okay, so we are kickstarting for today's session. Today's session, the topic is building wealth, which is saving, spending, and investing wisely. So the theme for this program is early financial literacy for young professionals. So it's basically investment strategies for young professionals to explore. So we started with introduction, mindset, understanding income expenses. So today we are learning how to build saving habits and smart spending, and also introduction to investment. So money flows in two directions. We have the inflow, we have the outflow, which is the expenses. Then where everyone talks about wanting to save, few actually do. So we all talk about we want to save, we want to save. I plan on before the year end, I want to have XYZ amount in my account. Most of us, we do more of the talking, but we don't put it into action. So many young people wait till they earn big, and you don't necessarily need to earn a huge amount of money before you can start investing or before you can start saving, or before you can think of the best possible way for you to start saving. So, but the truth is that if you don't save when your income is small, you won't be able to magically start saving when you start earning higher. So that is just a summary of it. So to the next slide, why saving matters. I think I've mentioned this earlier for those that were in class earlier, like last 2 weekends. The reason why we save is for us to be able to have emergency fund. And you know how the economy is right now, and the economy is not really favorable to some people. And imagine young professionals that just finished school, that just graduated, and if you check the annual or the average income for young graduates that just finished the NYSC, they are averagely earning like 200, 250, max 300. It's just few companies that might be paying them up to 500 or maybe 1 million. So, and you taking a young professional that just finished school, and your average income is between that bracket. So you might be looking out for best possible way for you to invest. And in order for you to invest, you also need to save. So why do we save? We save for emergency fund. So in case you have such an emergency like hospital bill, something happened, unforeseen circumstances. These are the reasons why you save. So for opportunity funds, sometimes opportunities come like a short course, travels or things, something like investment. So for peace of mind, you actually don't want to be in some people's faces because you're looking for funds. And it might bring what they call see finish. So every day you're in someone's DM asking the person for urgent 2K, urgent 5K. It can be kind of embarrassing sometimes. So these are the reasons why you need to save for the rainy days, save for days you know that you might need this money. So this brings us to investment strategies that we're here to talk about. So moving to the next slide, practical saving habits. I think I've mentioned this before, that the previous class where we have some certain percentages. We talked about the needs and wants. So you don't have to wait till you start earning big. You can begin with, I wrote 100. We might not typically use this example here, 100 naira, 500, or it might be 20,000, 50,000, depending on what you're earning. You know yourself, you know how much you earn, you know how much you can set aside on a monthly basis for you to be able to invest. So you also kind of automate your savings using some app I mentioned earlier in the previous class. Then once money enters, you can actually make it a direct debit that by default to just debit you a certain amount and to be going into your investment account. So you have options to do that as well. So and the saving goals. Savings are divided into three categories. You have the short-term goal, you have the medium-term goal, and the long-term. The short-term are for you to meet your short-term obligations for things that spans between 0 to 12 months. So or something like that. Then medium term it might be between that should like getting a certification, like getting obtaining a program like your master's, your BSc, that one, you know, that is above a year, like 2 years or something. Then long term are kind of capital intensive. So you might save for you to get a house, mortgage, investment, and also start up a business or something like that. So you can categorize your goals in different forms. You have the short term, the medium term, and also the long term, building like an emergency fund for it. So smart spending habits. I mentioned earlier the difference between, I think someone gave us the difference between the needs and wants. So needs are essentials for survival, while wants are not necessarily essential. You just want it, like getting a phone, getting a new sneaker. Then delayed gratification. So if you're used to buying biscuits and all that, you can actually just set that aside and then you can set that aside, and instead of using that phone to spend it and unnecessarily, you can actually invest it as well. But I'll come back to that as we go ahead with this session. Resisting pressure and smart buying. So you have to also resist pressure, and you don't have to copy others because you saw some people are and I don't know, is it Nepo babies or Lapo babies? They already have trust fund, they already have things, their parents have already made their future for them. They have already established something good for them. So you don't have to put yourself under pressure or copy someone else because you saw someone got this, you want to follow suit. So you have to budget for fun, you have to also plan for it and have to do away from pressure. Don't fall into the wrong path or maybe be vulnerable to Ponzi schemes as well. So this brings us to the 50-30-20 rule. 50% of your income should go to your needs, 30% should go to your wants, while 20% should go to savings and investment. So it depends. You can readjust this percentage as your income also increases. You don't necessarily need to follow this. So it depends on your priority. Everybody's priorities are kind of different. So the eighth slide is why investing matters. We invest in order for us to get a return on investment. And another key thing we need to look at for is when investing, you have to look at, are they the investment platform you're making? Is it going to compound? Are they investing in form of in such a way that it's compounded, or they're using simple interest? These are the things you need to ask. You have to ask them, is this compounded on a daily basis, or is it like you are using a straight line method, more like a simple interest? So you need to ask, or is it compounded monthly? So I'm very sure mutual fund is a platform, an investment portfolio that actually compound years on a daily basis. So they calculate your interest daily, reinvest it, and you get your return on investment on a daily basis. So you also, while investing, you also have to look out for inflation. Inflation can actually eat into your income. And if the prices rise 20% in a year, but your bank pays 2%, your money loses value. So you know that inflation is like 20%, and where you're investing, the investment platform you're using, they are giving you 2%. Like, it doesn't really make sense. So if you're doing your calculation, do your research, know the best possible investment platform you can actually invest in because of inflation. And you also have to take cognizance of FX and changes in the FX rates, more like the foreign exchange rates. You know how dollar and naira is going right now. I think naira has been steady for a while. It hasn't gone beyond 1,600 per dollar. So you also have to take cognizance of it. You do your analysis, you ask yourself, is it best to do this? And I have some of my colleagues in the office, they do what they usually do is that they are in this cooperative society that they can get a loan from the cooperative. And I think the loan from the cooperative is like 10%. They give you as low as 10%. So let me say that you've made a total contribution of 2.5 million. You're entitled to 200% of it, which is making it 5 million. And you get a loan of 5 million at 10% per annum from your cooperative. You can, if you don't have a need for that right now, you can take that 5 million, invest it in your mutual fund. Mutual fund, the minimum rate is like about 19%. Sometimes it goes up to 20, 22, depending on the MPR and the market trends as well. So these are the kind of analysis you can do as a young professional. You just have to be up to date. Watch Nigerian news, business news to know what to do, know the kind of investments you need to make. So as you can see, that move is actually a very smart move for you to take a loan, and maybe you don't really have a need for it and be repaying that at a very low. So if you do your calculations, if you do your calculations, it's actually a good way to make sure that you don't have idle funds sitting down somewhere. At least your money, you're using your money to earn more money. Your money, as in the money you have in your account, or you have in any form of investment platform, at least it's yielding income. You don't have an idle fund lying around in your bank account. So it's a smart way to also um, invest. So the power of compounding, I've mentioned this. You compound, let me give you, for example, you have 100,000 naira and maybe you invested it, you put it in a fixed deposit, for example, and it's 10%, they gave you 10% per year. So and you fixed it for 5 years. So you're not going to you fix it for 5 years. What we mean by compounding, is that for the first year, you're going to get both your principal and your interest rates will sum up to 110,000. For the second year, it's not going to be that 110,000. So they are reinvesting that 110,000 for you back. So what you will get total is 121. That means you're getting 10%, 1.1 times the 110, you get your 121. So it's really compounding this way till you get to the 50. You see at the end of the day, you're getting up to 161. So instead of leaving that, so this is for those that are being compounded on a yearly basis. So, but some are being compounded on a daily basis. So if it's that way, you know that the interest rate the interest you're going to gain on this form of investment is going to be higher than it. So that is what I mean by it being compounded. I'm sure that most of us, we have done it back then in university and secondary. You have where you have the present value, your net present value, your future value, interest, and you discount it and stuff like that. it has its forms of this formula. You can check that online or any form of textbooks you can lay your hands on to research money. This takes us to investment. And I hope I'm not rushing, Sha, but it takes us to investment. What we understand by investment, and um, it takes us to the definition of investment. What is investment? Investment is the act of committing money or resources to an asset or venture with the expectation of generating income or profit in the future. So investment simply means you're pouring in money into something and you have expectations that you have good or it will yield good returns at the end of the day. So why do you invest? You invest because of inflation, for you to beat inflation. You invest to beat inflation, you invest to grow wealth instead of leaving your money in your account. Because at this present age, anybody that is leaving idle cash in their bank accounts, I really don't know why they are leaving there. Because if you keep your 1 million in your bank account, at the end of the day or at the end of the year, what you see there is 999,999 and something. They will take their bank charge, take management fee, take a lot of things from, and you see that 1 million naira that you kept in your account is not yielding anything for you. It's just they are lying down. You didn't invest it in any form of business. You didn't put it in any form of investment platform for it to yield. You actually didn't spend it. It's just the value of that money is just depleting every year. So the reason why you invest is for you to create multiple streams of income. I know we do 9 to 5, and maybe some people that are kind of blessed, multi-talented, they have 1 or 2 gigs that they're doing by the corner. But for those that really do not have other things to do, the reason why you need to invest is for you to have multiple streams of income. It sounds somehow that every month you're being paid 300,000 or whatever amount you're being paid, it's just in your account lying down there. You've not used it to start up a business. You actually did not use it to invest in a safe platform that will yield interest for you. At the end of the day, that 1 million naira is still there. You might even check your account, it's just that depleted down to 990 something thousand, and which is actually not cool. So the reason why we also have to invest is for us to achieve financial independence. At least I mentioned it, but at least in case you have a form of emergency, it will also help you. You can go and liquidate your phone and use it to sort out whatever need you need to sort out without facing off any form of embarrassment. So it takes up to, I know I ended on the 10th slide, yeah, but I'm moving down to types of investments. We have 3 major types of investments that has its risks that is involved. We have the low risk form of investment. We also have the moderate risk form of investment. We have the high risk form of investment. So these investments, they are being classified into 3 categories. It's not all investments that are the same. For the low risk, you have your savings account, you also have your treasury bills, you also have your mutual money market funds. So this form of investment is actually very low. It has a low risk associated with it. Excuse me. So I'm coming. Is the risk here is kind of low. What I mean by low is that you won't lose your money, and if you're investing in treasury bills or government bonds, at the end of the day, you're very confident that the federal government will pay you both your principal and your interest. There is no long story. They're not going to come and tell you that they should bed mama fly. So they're not going to tell you any form of story. So you're sure that at the end of the day, you're going to get your interest. So the moderate risk, which is the medium risk, is kind of they have the bonds, buying bonds and real estate is kind of moderate. But to some people, depending on the kind of experience they've gotten so far in terms of real estate, is that some people are falling into the wrong hands Some people claim they are running a real estate, but whereas they have something else at the corner. So why we have a higher risk, which is stocks, cryptocurrency, startups, and FX trading. If you're not a G in this field, I won't advise young professionals to go into investing in such, because you really don't know how the market works there. You're a novice, you're not a stockbroker, you're a novice, you're just fresh, you have 0 to 2 years of experience, and you're just looking for a safe place for you to invest your money. So investing in stocks is not really, because right now, currently, I think the stocks are not really doing well. The reason why I know they're not doing well right now is because people are being paid their dividend. So it's your money that you use in investing right now that they're using to pay off dividends of to those that actually invested in stock earlier this year, and maybe as at January 2025. So if you're not in the game, you might put in your 1 million in the stock market right now, and you see that you're having a negative balance. In fact, you're even owing them. So the risk there is high, so high. And cryptocurrency, we are very well aware of that. If you're not really knowledgeable about the market, it's not advisable you just start off with these high risks, because and FX trading, you know how volatile the FX market is right now. So it's not wise. So the safest form of investment is to invest in the low risks and also the moderate form of investment, which is what I mentioned here. We have the government bonds, the TBs, the mutual funds, exchange trade funds, and that is it. But the people that invest in options and futures are those majorly in the oil and gas field. They use that in the oil and gas field to hedge against what they are importing mostly, and also for commodities as well. So you can do your research, make your research, and the safest is mutual funds. The mutual funds is a kind of the safest. I think the interest rate now, I think it dropped to 90%. Actually. So what's the difference between saving and investing? It's simple. Saving is just so low, like you're just saving money, you actually did not invest it. But while investment, every form of investment has a risk associated or maybe attached to it. There is no investment that is just that you have to categorize your the risks according to the level. Because the reason why stock is higher, because it's more like the higher the risks, the higher the return. The lower the risks, the lower the return. As simple as that. So if you're investing, don't just you have to calculate your risk appetite, know how much you can chest in terms of investment. Because as human beings, we have three different types of people. We have people that are risk prone, we have people that are risk neutral, and also we have people that are risk averse. So what I mean by risk prone, risk neutral, and risk averse is that risk prone it means that the person enjoys taking risks and prefers uncertainty over certainty. So these are the kind of people that they love taking risks. Anytime you see anything risky, they are in the front. So these are the people that they will hear about something now and immediately they really do not care, because they know that the higher the risks that they have, the returns they're going to get is going to be higher. So it's more like people that are investing into startup. Imagine someone is coming to pitch to you, and my name is XYZ. I have this app I want to develop. After pitching the whole thing, I'll come and invest in my company. Invest in this, I will give you an equity of this, maybe have a return on investment of 50%. The person might just give you the money for you to do start your startup business. The person that is giving you that money is actually taking a huge risk, because this is a new company entering into the new market. So the risk there is higher, but he believes that the return he's going to get from such investment is going to be higher than other forms of investment opportunities. So betting also, cryptocurrency, the return there is very high. You will see someone that invested in crypto with just maybe $100, $200, you see that the person is already the kind of returns the person is getting is like almost 1,000% or 500%. So the risk there is also high. But when it goes south, you might end up with having as very low returns or maybe negative returns. So someone that is risk neutral is a person who is indifferent about risk. You're not there, you're not here. It's more like whatever. So they care only about the expected outcome. So they they are really they whether it comes with risk or not, they whether you make a gain or not, they are just neutral. They're not there, they're just being neutral about the whole thing. So for people that are risk averse, these are people that do not even like taking risks at all. They like peace of mind. So, and people that are risk averse, they don't really go. Like, will I put it this way? They don't, not that they don't go far, but they don't really make it because they are not ready to take the next step to invest in that business, invest in that investment portfolio that might give them a huge return. They are really careful. They take their time. So you have to ask yourself, where am I? Am I a risk averse person? Am I risk neutral? Am I um, risk prone? So risk prone are those that are up and doing. If they hear that the stock market is booming, they are ready to empty their accounts and invest all they want. And most of them, they have lost a lot of money. I know they have also gained a lot of money in the long run. So it depends on where you find yourself. So where you find yourself. So I'm taking you down to the low risks and the moderate risks, and for those that want to invest in investment platform that has a very low risk, there are some pros and cons that come with it. For people that wants to invest in money market and those that wants to invest in treasury bills or government buying commercial papers and all that, is a very safe space. It's a safe investment platform or portfolio or option. So is the market is predictable. You're very sure that the government is going to pay you both your capital and you can be highly liquid because you can use your treasury bills and go take a loan as collateral. You can use it as collateral whenever you want to go to bank and take a loan. So the cons that comes with it, but more like the disadvantages that comes with investing in treasury bills is you won't have much return. It comes with low return. And sometimes if inflation increases to 30%, it's not going to, federal government is not going to say because inflation increased to 30%, then that 15% they gave you, and they want to adjust it to 20% so that it can be able to match up with inflation. No, you can't use it to hedge against inflation and limited growth potential. Sometimes it's subject to fees, maintenance fees, withdrawal fees. And if you withdraw before the maturity days, let me say it's 270 days, 190 days, 180 days, depending on the one you bought. If you try to withdraw before then, it has its penalty. You pay for some charges, maintenance, and stuff. So these are the cons that comes with investing with low risk portfolios as well. But the pros outweighs the cons. So the advantages is more than the disadvantage. So for those that want to invest in moderate investment platform like the bonds and the real estate. Bonds, there's steady income. One of the advantages that it has steady income through interest payments is safer than stocks. So buying government bonds is better than buying stocks because you can buy 10-year bond. That means you've locked it up for 10 years and it's better than stock. Stock market is a very risky market. So mutual funds is diversified, is professionally managed by professionals, and also real estate is a tangible asset. So for real estate, it's a tangible asset, and you have potential of getting income from it, and you can also use it as a collateral as well. Then generally higher than the low risk. So for those investing in this, is higher than the the low risk or low investment portfolio. So and one of the disadvantages of these medium risk portfolios. It's just that it's still vulnerable to inflation. It's the same thing. Requires then for real estate, it requires large capital, and you can't easily liquidate it. Imagine buying a house, and if you need cash immediately, you can't. How many people are willing to buy that house from you immediately, and you need instant cash? You can't really get. You can't liquidate. You won't be liquid. You won't have enough cash flow at your disposal to make use of when needs arise. Then one of the disadvantages is that market fluctuation can still affect it. It can still be affected by government policies, market fluctuation, and some other external factors that can also affect it. Then high risks, these are stocks, cryptocurrencies, startups, FX trading. These are very high risk. So high potential return. One of the advantages is that you have a higher return compared to the medium and low investment. So you can be paid both your dividend and also your capital gain. So for crypto, you have huge profit potential in short time, but because of the high volatility of the market. So for startup, early investment can lead to massive payoff if business succeeds. So imagine if you are among those people that they pieced a small business to, and you had to just invest in that startup. And imagine when that startup now grows, and wow, you're going to get huge returns, huge dividend, because you are part of the early birds that invested in such startup company. So you have the FX trading, so they have the liquidity and the opportunity of profit from global currency movement. So those people that are into FX trading, imagine when dollar increased to 1,800, some people were really cashing out that period, because then when now imagine if you bought naira we bought dollar at 1,500 or maybe 1,600, and it skyrocketed to 1,800. You're going to make massive gains. So then maybe due to one or two things, good rules, good government policies, things have now, inflation is reducing, and then naira now got down to 800 naira or 400 naira, and you still have that dollar you bought 1,500. It's actually you're going to make a huge loss on it. So the higher it has, although you make higher returns in it, but it also comes with higher risk. So the disadvantages of high risk is that high volatility. Values can drop suddenly for no just reasons that you might not really, you can't tie them directly to your investment. So possible total loss of capital. You can easily lose both your principal amount, your capital, and even the interest in those high investment platforms. So it requires knowledge. If you're not knowledgeable, if you don't have a finance background, or if you don't consult people that are actually into this, or maybe investment banks or investment companies that can advise you, or this is the best stock to buy. Okay, Dangote is performing well. If I don't buy stocks in Dangote refinery, buy in Dangote sugar. Don't buy there, buy Dangote cement. So you have people that are already monitoring the market to advise you on things or the right company to invest in. Don't invest in this, invest in that. So you have to be knowledgeable. You have to do what they call research, understand the trend analysis. You should be able to interpret financial statements to know if you look at the financial statement of the company you want to invest in or buy the shares or stock in, compare it year on year. Ask yourself question: are they liquid? Are they this? Or how am I going to get my? So you have to be knowledgeable. You have to be disciplined as well. So those are the cons. So most of us that are investors and young professionals, you might not really have the time because you're juggling from one job to another. You're juggling from this job. You're juggling from this. You go to work 8 o'clock, come back 6 o'clock. Lagos traffic. When is the time for you? Maybe you're also running your program. You really do not have time. You're actually looking for something safe that you could invest your money to, that you will not really have just lose your money just in a twinkle of an eye. So these are the disadvantages. So I can advise young professionals to jump straight into buying stock and just so high investment portfolio simply because it has higher return, because you're most likely going to lose both your principal, your capital, your interest. So one of the disadvantages of such high risks is that regulatory uncertainty. There's a lot of uncertainty that comes with it. Federal government can come up with one policy and the whole thing will change. Remember when there was that was 2023 when the government said that there is no longer this thing subsidy. Look at the way prices of things skyrocketed. Most businesses that actually did not even plan for that, imagine how much they must have lost on their investment on goods and everything. So government policies can play a major role in such investment platform. They might come and change one tax, introduce a new tax policy to come and tax your FX, to come and tax your crypto. So many factors could affect such high risk, high investment portfolio. So the pros here are more than the cons here are more than the pros. So, and these are the investment options for beginners, and they have, I think I've mentioned, I've tried to dissect it into three different forms. They have the high, the medium, and the low investment platform. And it depending on your risk appetite, if you're risk averse, if you're risk neutral, if you're risk prone. So it depends on who you are. So you see that people that are risk prone can rush straight to high investments. People that are risk neutral can go to the medium form of investment portfolio. Then those that are risk averse, that they don't want problem, they will just go and invest in their treasury bills, buy government bond, and they'll just sit down and relax. Yes, they are comfortable getting their average return. If it's 15%, if it's 19%, they are good because they have many other things to do. So one of the things I actually did not mention that you can invest in buying of lands, but lands also have its pros and cons. We are all aware, that federal government can come and say that they want to use that land and then develop airports. And if you don't make good due diligence on that land before buying it, involving real estate professionals, involving your lawyer, making research to know if this land is under dispute. So the buying of land again it also have its advantages and disadvantages, but it's also safe. You can buy the land and you before the next 5 years it will appreciate, and you can sell it or use it to do whatever you want to do. You can use it for farming, you can use it you can sell the land, you can build on it, or venture into real estate, or become an entrepreneur. So you can use it for so many things. So as a young professional, it's advised we make our research on it, and then set a plan, set a goal. Like, I know that 30th December is around the corner. I know of someone, a colleague of mine, that has she downloaded this app, um Harvest, called Harvest. So her goal is to have enough funds for her 30th December. So they're debiting her like 2,000 or 3,000, 2 to 5,000. She actually didn't disclose the actual amount, but I know it's between that range. So, and it's more like a direct debit from her account into the app. So, and it's being compounded on a daily basis. She gets her interest. So imagine, let me just say plus minus that is 5,000. Then imagine 5,000 times 190. So it's 950. And this 950 is on, I'm just calculating the capital. So imagine when it's being compounded on a daily basis, you calculate interest on it on a daily basis. So before that December, she already have funds set aside. So this is more like, I think I mentioned this earlier, delayed gratification or something like that. So I've mentioned it earlier, hey, delayed gratification. So it's something like you have to just do away with some things, maybe that money you use and buy sweets, use and buy necessary things that you actually don't. Just it's a form of investment and a form of you setting out funds for you to invest in. So I think I've dissected and I've talked not really extensively on investment platforms, but for young professionals, it's advised you look at these things and ask yourself, how much do I want to make? And then you invest. So I think the next class we'll talk about maybe retirement plans and I think we'll talk about um some I think we do might do a little bit of calculations on it also working net present value and present value and future values as well. So these are basically the forms of investments you can actually invest in as young professionals. So I think I've come to the end of today's class and this is the time for any form of question if you have any. Thank you very much.
Thank you very much, Ma. Really learned a lot. If you have any questions, please ask your questions. Okay, Ma. I don't have a question, but I just want to say something, Ma. Can you hear me, Ma?
Yes, I can hear you.
While you were teaching about the bonds and mutual funds, I was actually searching for some mutual funds for beginners, somewhere we can invest. And since you said you don't advise us to just go into something, we have to study it and make our research. Is there maybe one or two that you know that we can at least just have so we can then make our research on it? Maybe there are some mutual funds, or something.
Okay. Okay. I know of GT mutual funds. I know of Stanbic mutual funds. So, okay, if you can research on it, and I can actually send you a link on how you can go about it. I'll send the link for the registration on the WhatsApp group. So that's the Stanbic Mutual Fund is the one I am currently using. It's actually a safe space. It's seamless. You don't need to go to the bank for you to you don't need to go to the bank for you to enroll in it or maybe to register. You can do it in at the comfort of your place. So I will send you a link you can use to register it as well. So depending on what you want, for those that are not really comfortable using GT Stanbic Money Market, you can, if those that have GT Bank, if you have an account officer, you can call your account officer and ask them for their portfolio on what they have to offer. They can put you through it. So it depends, but you have the ARM. I'm sure they also offer such services. Stanbic Money Market, GT Money Market as well. So you can research on it if you want, but these are the three I just mentioned. Three. I will send the link to the WhatsApp group. Thank you for asking.
Thank you very much, Ma. Okay, any other question, please? Okay, someone is raising his hand. Okay, Abdul, please, you can unmute your mic. Abdul, you can ask your question.
Yeah, sorry, good afternoon.
Good afternoon.
Yeah, good afternoon, Ma. Thank you for the insightful session this evening. I actually have a little question. My question is that when you mentioned uh that we shouldn't have idle money in our account, does that include or exclude our savings too?
Okay. Your savings account, right? I want to know, be sure that I got your question. Does that include your savings or your
Yes, ma.
savings?
Like our yes, ma.
Okay. I would like to use an example to answer this question. For example, now I finished school last year, 2024. This is 2025. I got a job. They're paying me 300,000 naira. Luckily for me, I'm staying with my auntie here in Lagos. So my salary is 300,000. I don't have much things to do because I'm coming from home. I'm going to work from home. Okay, and I opened a mutual fund account. And to open it, I need to have a minimum of 5,000 naira, and then I can put any amount. So I can put any amount in the mutual fund. So looking at me, I know that on an average monthly, I spend maximum of 80,000 naira every month, plus minus. Then if I exceed it, is to just go up to 100K in a month, maybe transport, these, and I'm not spending much. So I know that at the end of the month, I will have like 200K if I'm very prudent in my spending. So in the next few months, like 3, 4 months, I will be like, okay, let me put it this way. Let me just be investing 150 every month into my mutual fund and keeping 150. So in case of anything happens. So I'll be investing 150 every month. So I have 150 out for my spending out of my disposable income. So I just have 150 to me. So I know that even with the 150 I kept in my savings account, there's no how I will exceed 100K. So it's something, I'm not saying that you shouldn't have money in your savings account, but you saving your money in your savings account or saving your money in your current account, when they will still charge you by management fee, they will charge you bank charge, they will charge, and with this new tax law that is coming up right now, so they will charge you. So it's best you just invest your money in money market or any form of investment platform, and it will help you. At least you don't have an idle cash lying down, you don't have money in your Access Bank or any bank you're using, they're just lying down there. At least your money, so, and it's flexible. Anytime you need funds, you can just go and redeem your funds, and you can redeem it and you make use of it. It's not, you shouldn't liquidate everything. You can just liquidate the exact amount you need to maybe fulfill such any form of obligation or anything, any need that comes that arises. So you can use it and you move forward. So keeping money in the bank lying down there is not really advisable. So far you don't have a business you're running, you don't have a shop you're running that you can pour in the cash back, maybe use and buy more goods for turnover, increase your stock in your shop, increase whatever the thing. But so far you're not doing that. It's best you just invest it. So you should have a savings in your account. So at least you can use that to run your day-to-day activities. At least you will eat now. You have to eat. So why? It depends on you, your risk appetite, how you spend your money. Everything still falls down. It's just all about discipline and planning. So that was the reason why I started a class with planning, budgeting, also understand what income is, expenses is. So with all these things, if you categorize your spending, you could be able to do it. And for young professionals, this is just the safest. So by the time you have like 8 years experience, you're now earning in millions, earning cool cash. That is where you can just close your eyes and say, I want to buy stocks in Dangote, Apple, all those big companies, even if they, no matter what, you won't feel it. So that is what I mean. Did it get me now? Did you get me?
Yes, ma. Thank you very much, ma. I got that. I think I actually wanted to ask a second question, but your explanation already answered my other question. Thank you very much, ma.
Yeah, you're welcome.
Okay, since there are no other questions, or is there any more questions? Okay, since there are no questions, I think we have come to the end of the class. Thank you very much, our mentor, Miss Chineye. Thank you so much for this inspiring and insightful class.
Well, thank you very much, everyone. Thank you for your consistency in attending this mentorship session. And as I said earlier, I wish I had this class or this mentorship session when I was coming up as well. So at least I know that I could have gone far in terms of investing. I know how to plan my life. I know how to invest. I won't spend unnecessarily. But I'm happy to have you guys for today's class, and I'm looking forward to see you guys next class as well. So thank you very much for your time, and do have a wonderful weekend. Bye.
Thank you, Ma.